Thanks everyone for joining the second TIE webinar series. This one is called Now You VC Me, Now You Don't. We have here with us a few very esteemed people from the VC space working in crypto: Feng at CoinFund, Brian Johnson at Republic, Thomas Klocanas, general partner from BlockTower. So would love if you guys could just take a second, go around, give us the quick intro on what your background is and what you do in the space.
Thanks, Jack. I guess we can go in order that you mentioned. Hi, everyone. Thanks for having me here at the TIE. So my name is Feng. I'm one of the partners at CoinFund. I'm also our director of research, so I work really closely with the investment analyst team across our strategies, both venture and liquid. My own background is actually traditional finance as well. Like many of the folks on this call, I started off my career doing investment banking at Barclays and then long short equities at Citadel and then Point72, where I covered stocks within tech, media, telecom, but fell down the crypto rabbit hole during the garden leave between the two funds in early 17, and the rest is history. Have been full-time in crypto for 4+ years, at CoinFund for 2 years, and actually became friends with Josh, founder of the TIE, even prior to starting at CoinFund. So really pleased to be here and excited to participate.
Yeah, thanks, Jack. Brian Johnson here, partner at Republic Capital. Just like Evan, I have a traditional finance background. Got into crypto in 2012, but really didn't dive in until I joined a family office in 2017 during the ICO boom. Funnily enough, we were doing crypto and cannabis at that time. They kind of went hand in hand. They went up at the same time and they went down at the same time with the last the bear market back in 2018. Fast forward to 2019, joined Republic to help form Republic Capital, basically grow the AUM of Republic as a whole. And I focus on the crypto and the gaming side of our investments.
Thanks, guys. Thomas Klocanas here, partner over at BlockTower, specifically looking over the venture side of things, because we've got a couple different strategies, which is, I'm sure, something we'll touch on this call. At the risk of being super unoriginal, also started my career on the investment banking side of things across a couple of different bulge bracket banks, transition over to the equity research side of things, covering European tech and banks at Barclays, actually, Evan. Which is actually interestingly where I caught the crypto bug back in 2014. At the time, I was covering fintech and sort of payment stocks when some clients started asking us, what the hell is this Bitcoin thing? And that's actually a direct quote. That led to us sort of doing some of the very first research on the space. Fast forward a couple of years, realized I couldn't quite shake it, made a move into the space at Consensus from 2017 to 2019, before hopping over to the venture side at a generalist fund called White Star Capital, where we raised a $50 million digital asset focused fund. And more recently, back in December last year, joined the BlockTower franchise to help formalize what we're doing on the venture side.
Yeah, so as we can see, clearly a very, very accomplished list of people here with me. So very excited. I'm Jack. I represent the TIE's research team. My background is, at risk of being redundant, also at a bulge bracket investment bank, caught the crypto bug, fell in love with DeFi especially, and joined the TIE coming up on a year ago now, where I have been helping run our research team. So without further ado, we can start right into it. And I think the best place to start is actually probably the toughest question of the day, but the one that everyone kind of wants an answer to, which is, over the last bull market cycle, there was a lot of questionable tokenomics, questionable practices from very large players in the industry, you know, owning a VC while owning an exchange, while owning the research team, while also making markets for it. And then that tied into just dumping on retail a lot of the time, for lack of a better word. But at the same time, these people also had their money where their mouth was, and were just like max leverage long. But in doing so, caused a really painful unwind for everyone else in the space as things deleverage. So as we move forward, are there going to be more standardized best practices coming out from VCs where all of the best deals for tokens are going through these standard practice VCs, or where do you kind of see this trending towards over the next year or so?
That's a hot potato question. All right, I'll take a first stab at it, Jack. I think the short answer is I do think best practices will emerge, but it's also it's not going to be the result of a coordinated effort. I think what I've always loved about Web3 is there is kind of this beauty in the chaos of what truly free markets look like. And I think people that are over levered and exposed, and as you mentioned, putting their money where their mouth is, and having that not work out. I think it's just part of the growing pains that our industry continues to go through. While there is some ability for forced coordination, we're seeing that a little bit on the regulatory side with AML and KYC. I still feel that ultimately best practices will just have to emerge through not only sort of the push from centralized entities, but also the pull of just, founders demanding more, maybe from their investors, right? Like more post-investment value add, maybe more post-investment support specifically on some of these, token issuance dynamics, or just demanding maybe better separation of some of these conflicts of interest from the people that they interact with. I know, for example, maybe passing the mic to Brian and Republic, I think Republic's actually done a really good job separating the different divisions and practices, and even spinning other like Realm out, for example. And I think having those clear lines probably structurally are going to be a source of their competitive advantage, but also represent more clearly like where the boundaries are relative to what founders may or may not know.
I could add to that, and thanks for the comment, Evan. I think on the questionable token economic side, right now everyone is, I think everything is an experiment still, right? And we, with regulations being uncertain, everyone's trying to, be a security at the end of the day. They want to be a security, right? And that's why you have these new real yield projects coming out. You have revenue sharing, or trying to figure out a way to navigate around revenue sharing. So I think in terms of what is the right token economics, and we do a lot of the advising on projects too with one of our divisions called Republic Crypto. We've seen a lot of different token economic models come and go, and on the regulation side, I think it'll definitely make it a lot more clear on what is the path forward. What is the section where maybe you're okay on the insurance side, like here's where you're covered on FDIC, and then here's where you can be a degen. I mean, that's like I think maybe like the holy grail in terms of regulation side. Right now we see a little bit of a heavy hand in terms of privacy and free speech, but yeah, to your point, Evan, also on the what founders ask of investors, I think they'll definitely be asking more too. I mean, in the bull market, they definitely ask for more, like what is your value add, a lot more. But in the bear market, they tend to say like, when can you fund? But yeah, I think in terms of all that, we still need to have a lot of room to grow in terms of just what is the right model. I think there's a lot out there.
Yeah, there's a lot in there, and I agree with some of what's been said. I would add though that like a lot of best practices already exist, right? Like we're talking about token unlocks happening too quickly, dumping on retail. If you sort of look at when you're supposed to get traditional exit liquidity, whether you're a founder or you're a VC investor in traditional Web2 startups, that's often 5 to 10 years out, and you get it at the same time as the founder, and you typically get it after retail in the case of an IPO. We kind of all threw that out the window for the past couple of years, and I say we as the investor community, the founder community. And part of that is just sort of resetting expectations as to like how long does it take to really build something that's going to stand the test of time, as opposed to something that might make money if you exit at the right time in 1 to 2 years. And in 2021, it was really easy to sort of forget those best practices and think shorter to medium term, given how fast things were going up and to the right. Rounds getting marked up every 6 months, founders getting oversubscribed by 3x, like that's objectively not normal. And so all of that coming down will hopefully make both entrepreneurs and investors sort of think more long-term. I was having a conversation yesterday with a founder who was talking about the vesting for the token in his round and telling me that he was trying to get his team a better deal. We were talking about a 2-year vest. So I kind of pushed back and said, that's a tremendous deal. Frankly, that's more of an orange flag for me than anything. But if your concern is that your investors are vesting before you, that's the problem. That's the first lever you go and need to go and fix, right? So back to sort of what Evan and Brian were going to say, it's demanding more of your investors as well. And it's also professionalizing VC in the space. Like we have had a number of investors do venture deals in crypto. but not all of them think like venture capital investors who think a lot further, want to partner with a more narrow portfolio of entrepreneurs and back them for a while. So I do think there are some Web2 sort of learnings that we can take and apply to this space. And part of that is also leaning into a little bit more patience than perhaps the market has allowed us to in the past 18 months or so.
Absolutely. And I have kind of a follow-up question for that based on something you said. Something that's really interesting to me personally, right, is when you think about these longer term investing deals, there's kind of a reason for shorter term deals in the space that isn't just VC read or whatever the negative term is, right? It's at the same time, if we even look back 5 years to the 2017 run, the majority of the tokens that were relevant then aren't relevant now. Even DeFi 2.0, majority of those tokens aren't relevant now. So from a VC perspective, it's really hard to actually think about, just because this infrastructure looks really enticing right now, someone may invent a better design for Web3 in 2 years that I couldn't even conceive of now. And all of a sudden, all my capital is stuck in a long-term unlock that isn't even the best way to fund the space if I'm doing this purely from an EV positive perspective. How do you kind of think about balancing those different factors?
Yeah, that is another hot potato right there. But I mean, there's a couple different ways to think about it. One is like, what game are you playing as an investor? Are you going for 2-year wins? Like, what type of fund are you? Are you an open-ended fund that needs to return capital quickly? Are you a long-term VC fund where your funds are locked up for 8 to 10 years? I think that'll dictate a lot of the types of opportunities you're going after. It's very different to try and back a Coinbase, right, who gets exit liquidity years out in the tens of billions of dollars kind of return. But with a token, if you only write a smaller check, you can get 100x on your check pretty quickly, even if you don't have institutional exit liquidity, right? A lot of the tokens we're talking about in your kind of example, they're pretty thinly traded. Like even Solana, the investors who backed Solana, a lot of them returned in kind because they couldn't have sold it at that price. You couldn't have realized it at those marks. So I think there's a little bit of thought to be done around, are you trying to back the next narrative, the next trend? And that's absolutely acceptable. That's one investment strategy. Or are you trying to sort of do the VC thing, 7 to 10 years out, what's going to win, what's going to stand the test of time? There's also probably a cultural / branding element, right? If you look at firms like USV, they've passed on deals over the years that were sure to make the money because it did not tie with their brand. It did not tie with their ethos. It did not tie with their mission statement. So I think in my mind, that's one. I'd be curious to what Evan and Brian have to say on the topic, because to your point, I think it's definitely a fine line to be dancing, and this space makes it a lot harder. But as funds get bigger, as we have to deploy more capital, I think playing the short-term game becomes increasingly harder because you just don't have sufficient liquidity. But yeah, guys, I'm super curious to your takes as well.
Yeah, Thomas. Oh, sorry. Go ahead, Brian.
Oh, no, you go ahead. It's fine.
I was just going to say, I think the axis that you identified, Thomas, like the long versus short-term game, is absolutely the way I'd frame it. And I think different people are optimizing for different things. People, I mean, firms, investment firms. I think it takes all kinds of investment horizons to make a market. And I definitely don't denigrate the firms that have, been very consistent generating returns, kind of on a shorter time horizon, sort of on a token only basis. But as part of the CoinFund team, I know that we're thinking, longer term as well, continuing to build our brand and our institutional recognition and support kind of from the allocator's perspective. And I think as those pools of capital kind of make their way into taking Web3, investing more seriously across various strategies, I think they also sort of demand some of what they know, traditional VC firms, like you mentioned, USV and others that maybe have a more sustained longer term view and are less excited about flipping tokens. So I think this actually ties back to the previous question and how does discipline come into the market? I think it does still come in fits and spurts, but probably driven by some of the demands of the end user, which in this case are the allocators that are supporting some of the new fundraisers that are happening with firms that are still active and deploying. And I think those firms in turn carry that signal forward to the interactions and even the funding decisions to entrepreneurs. And that ultimately does result in more, I guess, some of the best practices from traditional VC coming in. And I think that's not the end state necessarily that I would keep in mind. I mean, I think the end state will be not quite identical, right? I think there are pretty unique elements of Web3 that I think are here to stay. Some of the early liquidity, the flexibility, post hoc of modifying governance decisions or treasury allocations, or even ripping down an existing token and upgrading everybody against their will, even potentially for some of the minority holders, to a new token that reflects additional capabilities. So I think, I mean, preaching to the choir here a little bit, but I remain very optimistic that we can ultimately balance this short versus long-term dynamic, but it's not up to any one person to decide. It's just going to result from the signal that emerges from the chaos.
And yeah, to add on that from my side, I think it also comes down to branding too. Like Thomas, how you brought up Union Square Ventures and how they passed on several deals that could have made them a ton of money. I think it comes down to on the branding side from them as well. Like you don't want to, at least from their side and from our side too, we don't want to invest in projects that are really just going to, peak really quickly and then come down. And, we make money on our side, but at the end of the day, it's, I think it's a more of a hurts your brand in a way too. You're just seen as like a spray and pray. Whereas, on our side, we believe in the future of Web3 and, eliminating the middleman, right? And allowing people to be sovereign in terms of, their money and their financial freedom. And, if you, we're really careful on our side to try to pick the projects that are going to be around for the next 10 years and, at least be the future. And I think it is difficult though, because we are still very early in terms of just the cycle of where this technology is. But being methodical about it, I think is important. I think that's why you can see like Union Square Ventures, they went really big into helium. That's a great project. I think we were personal investors in it, not from our fund, but that's just one example where I think, they were very committed. They doubled down on it, and it was a great investment on their side. You can see that they're growing pretty massively. And I think it comes down to one thing is branding. Right.
And I would add maybe last thought is like, I think structuring matters in all this, right? If you are doing an investment and it's a SAFT, you're only in the token. Frankly, you probably want it to peak quickly because that token for a long time, that token might never evolve into being more of a network security, paying dividends out to token holders, right? If you're structuring deals the way that most VCs tried to and have struggled to in 2021, because it was easy to raise a $10 million all angel round where angels are less sensitive to this, and you're underwriting deals as, you're in the equity, you're backing the team, they're vesting their equity for a long time, but you also have some kind of a claim either paid or through your ownership to future tokens, token plural, because some teams have iterated making product after product in this space. Stuff moves quickly, it's early. That might be another lever that's most sustainable, right? Granted, there are cases sort of at the tail end of the spectrum where like for regulatory reasons, you don't want there to be any equity, but a lot of the time for the first year or the first 2 years, that equity can definitely be there. And it's probably a net plus, not a net negative, to sort of being able to foster that patience, iterate without having some of the bad behaviors we've seen. And I also think round compositions, like when everyone's an investor, no one's an investor, right? Like when you can fill out a whole $2 million round with 10K checks, no one's really looking for a big outcome, because even at a $200 million network with like 40% circulating, everyone has exit liquidity on retail. It's horrible to say, but it's true. Whereas when people are writing larger checks, they need bigger outcomes. They have to think longer term. And so I do think there's some conventional knowledge, going back to what we were seeing earlier, around like the fact that the way traditional VCs have done what they do, we can't just toss everything out the window. We have to sort of pick and choose what's applicable to the space, and does it need to be dialed to the same degree. I like an investor that comes in with conviction, but taking 15 to 20% of a round in Web3, in my opinion, doesn't really scale all that well, right? Is the number 1%? Should you be spraying and praying, so to speak? Probably not either. There's a spectrum. So just a couple additional thoughts there that came as Brian was going through those last points.
No, that's really interesting, and I appreciate that extra insight. I wanted to touch next based on something that you guys all mentioned in your responses, which is this idea of branding, right? And coming from traditional finance, like I have a memory of a lot of very famous VCs. You go on their website, it's like 3 lines and an email address, right? And now you look in Web3 and VCs and funds seem to have this huge content reach where the biggest funds also have the biggest following on social media and on their blog posts. And it seems like balancing that with actually putting together fundamental value and doing due diligence on a token behind the scenes has maybe gotten rebalanced a little bit for crypto. So how do you guys internally think about managing this expectation of being super client facing and public facing with also doing good work for your actual clients?
So I'm happy to take this one first, if cool, because I think we probably do it a little differently to Evan and Brian in that we're super stealth on everything we do. I think our website just says we have 4 strategies and that is it. That might change at some point, but I'd say like every crypto investor flexes a different muscle. For some, it's content. For some, it's policy. For some, it's we have devs who can help you deploy the next version of your protocol. For others, it's where we can, this is what we can bring, right? We can bring liquidity. We're governance very active in a couple of key protocols like Maker. And so I think it sort of goes back to like, what are you doing to develop your brand? Content is one big lever, but it's not the only lever. I think there comes a point when if you want to be one of those brands that stands the test of time, you have to have it. It can come from the brand itself, or it can come from sort of some of the figureheads for the brand, right? Like we talked about USV. I think Fred Wilson does a phenomenal job of developing his own brand with a very brief blog post every day. So just some high level thoughts, but I think on the media front, Republic and CoinFund definitely outshine us. So I'd be curious to the guys' responses as well.
It's a balance, and I would also say it's not uniform. So kind of interestingly, in a tautology, you know, CoinFund is a firm comprised of many different people. I would say I put myself more in the, like, there are people that are a lot better at the social media thing than myself on the team, especially ones that have been around longer. But I think, so the short answer is I see both sides of using, especially social media and sort of crypto Twitter as a return on time. I think for me, finding the right balance is getting to a level of activity where you are able to drive kind of engagement in DMs or have people outreach you with potentially differentiated sourcing. But at the same time, I think there's a pretty steep slope of diminishing returns. I think like we've all been there where we look at the time and we realize we spent way more hours or minutes than we intended to. And we initially were just trying to catch up on a deep dive thread and we got sidetracked. But I think overall content marketing is just one part of the strategy of differentiating a brand, whether it's an investment firm like ourselves or even, you know, portcos and apps, which is where I thought part of this question should also go, which is I think generally we are noticing that the power of branding is increasing, not decreasing in Web3, which is actually quite interesting and maybe not what the cypherpunks would have imagined, right? They would have, I think, thought, you know, products compete on their own and the lower lock-in effect actually means people get disrupted all the time. But we've actually seen that sort of flip around, whether it's, you know, Sushi versus Uniswap and sort of the reversion in terms of market share. And that's actually played out in many other kind of smaller product verticals as well. I think while Web3 is from a technology perspective able to be trustless, there's no getting around the cognitive load of trying to decide where to keep your capital or spend time. And I think shortcuts for that, solving that cognitive load problem as, you know, borne out by the presence of brands and the strength of brands as a shortcut to that is actually pretty interesting. And that shortcut obviously applies to investment firms as well.
I'm definitely awful at Twitter, but trying to improve. So I definitely lean on Republic as a brand and our main Twitter for, I'd say, retweeting our projects and when they launch. And I think marketing is a huge issue in crypto, to be honest. Still, you know, you have MailChimp basically blocking Masari recently, and back when I was at the family office, we had our own platform called RenGen, which was a security token platform. MailChimp blocked us too back in the day. That was 2018. And, you know, I think one thing about, you know, the value add with VCs is, you know, especially like firms like Multicoin, where you have Kyle, who has, I don't know, 100,000 followers or so. I think a lot of the deal flow comes from just that access that they have in terms of Twitter. Just, you know, if, you know, Kyle sends out a tweet about a project, you know, the amount of users can go up, you know, exponentially that day, where people just go in to try it out and see if they, you know, see if they like it. And, you know, if the platform's great, the users stay there. So I definitely think because there's you know, all this blocking on crypto in terms of marketing and advertising with Facebook, you can't really advertise crypto, to my knowledge anymore. Instagram, you can't. Google, you can't. So Twitter's really just kind of like been this new home for marketing in terms of all these new crypto projects, and VCs are kind of like a, you know, a replacement to Google and Facebook in a way. So adding that value add and definitely helps with deal flow, and definitely helps, I think, you know, bring more notoriety to new projects. So I think that's one thing that's you know, unique in the space.
Yeah, and it's something to consider for projects that raise capital from folks like us, right? Who's going to help you on content? Who's going to help you on regulation? Who's going to give sort of a technical expertise or be able to have some sparring sessions with you on that topic? If you're a DeFi protocol, who's going to help you bootstrap your first liquidity pools, right? Like, it's almost like there's a menu of things every project needs help on, and they should be picking sort of 3-4 partners per round to help them work through that. And to Brian's point, like, either certain firms or certain individual partners of those firms can help that content sort of be augmented exponentially.
Yeah, that makes a lot of sense. And you got to build your team based on what your needs are, right? And one of the things you mentioned, Evan, is early stage thinking about this core team of builders, and that really rung true with me, as I've seen a ton of different protocols, a ton of different builder teams really focused on decentralization, right? Like, oh, we need to be decentralized, token gated as fast as possible, do all of these things, move to a DAO. As someone that has spent time in DAOs and has seen a lot of DAOs operate, there are a ton of issues with moving to that sort of structure early on. I think most importantly, that the people that have the best ideas and are doing the most work are kind of hidden behind a wall and aren't able to operate as efficiently as they need to. So when you run into, and when you're assessing protocols that want to be decentralized and knowing that that's a big part of the ethos of crypto, one, do you see it as a binary outcome, or is it something that protocols can gradually work towards as they grow? And then two, what is kind of the best route towards decentralization that you've seen in terms of having the ability to scale while very early stage, but then still work towards this broad goal of being community driven?
It's definitely, I would say it's, I don't think anyone here would disagree that it's more a spectrum than binary. But I think in the way that progress is made along that spectrum can take a lot of different vectors. I think what seems to be more successful or pretty generally successful, or at least lower risk, is to the extent that a protocol has a token, leveraging that token to decentralize the supply and demand aspects of coordinating user behavior seems to be something that is easier than having that token be required for, or to have governance be decentralized before some of the day-to-day. And what I mean Uniswap is a really great example, right, where tokens were airdropped for users, and then also you know, still able to be earned by the liquidity provider separate from the token holders themselves. So I think decentralization, generally when we see our portcos make progress, it seems like it's always it's slower and more deliberate. And I think that that's actually fine from our perspective, because you really just have one bite at the apple, maybe a bite and a half if you really beg your community for patience if you mess something up. But I think the fact that it's a one-way street means piecemeal, slowly, and then picking like core functions to leverage token incentives to decentralize sooner, rather than the other pieces seem to be parts of the best practices that are forming. But I'm really curious what Thomas and Brian will say as well.
Yeah, you brought up the Uniswap example, which I think is a great one. One I'll call out before I answer the question is also what the Graph have done, you know, using the token and the DAO's treasury to incentivize new core developers to also develop on the protocol, thereby being able to sort of say like, hey, the original company that was behind this is not the only core developers. So what the Graph did is like the original team is still working on it, but they've also brought in the guys from Streaming Fast, which was sort of an inferior competitor that they kind of acqui-hired, plus Figment as third-party core developers. So you now have 3 core developer entities working on the protocol. there's a lot to do there on that front as well, right? How do you sort of point to like that prong in the Howey test around the expectation of profit that's derived directly from the effort of others that are a common enterprise? That common enterprise piece, I think, is a big piece of the equation. So yeah, I think the token is a great way to help coordinate that. Also, just like sort of repeating myself from earlier, but being patient. I think the community is quick on Twitter, on Discord to say when token, and that's great. But there are ways to sort of incentivize the user behaviors you would get with an imminent airdrops. Like, you know, a lot of projects are now doing XP points. It's pretty clear that those XP points will eventually translate into something if that something successfully launches, being the point, as opposed to launching it now before it might be successful because it's too soon. And then sort of knowing when the token becomes a full network security. Like for me, most tokens start out as memes utilities. They then have some governance. They then have some governance that captures fees, but really does nothing with those fees. Then maybe those fees start being redistributed to active participants of the protocol. I think the end state is fees being able to be redistributed to passive token holders as well, the same way you see it in traditional securities. The only difference being there's no common enterprise at that point. Hopefully will be these networks will be sufficiently decentralized, have multiple core developers, have a base of ownership, node operations, whatever, that's sufficiently decentralized whenever we get regulatory clarity on whatever that means, because we've heard that once and it's sort of a sentence that we all use. That will make everyone's life a lot easier. So Brian, I don't know if you'd add anything to that, but just a couple additional thoughts there as well.
No, I agree with everything you guys said. And I do think that, you know, you can't run before you can walk in terms of decentralization. Like you have to do it gradually. I think Joseph DeLong said it the best. I mean, I don't know if you guys follow just his whole you know, life at Sushi when he was the CTO, and just how the DAO just basically just ruined his life there, and he ended up leaving. I think there's still a lot of work to go on with DAOs, and just how inefficient they are at times. So I think maybe a model like representative DAOs will be like the future. But in terms of you know, right now, definitely decentralization is important. You know, like we see with Tornado Cash right now, how every project that you would think, you know, would be, you know, not block, you know, according to OFAC, is now blocking like Aave's front UI, front end UI. You even have Pocket Network, which I was surprised by. So definitely decentralization is super important, but I think you have to do it gradually in order to, you know, not have any hurdles. Because if you do too fast, it's just going to be a nightmare, and it's going to hurt the protocol more, I think, than benefit it.
No, I think that makes sense. And I'm happy you brought up Tornado Cash, because that's been one of my biggest questions over the last week, right? This is a very important move from the government, where by sanctioning a piece of infrastructure, a tool, a smart contract, how does that change the way that you're thinking about investing in tools and infrastructure broadly, knowing that, hey, this is being built and is potentially regulatorily questionable, but ultimately is just a tool, right? And we've seen mixed stances from the government on how they treat tools. So as you move forward, obviously Tornado Cash is something that's further on the questionable side than a lot of other things, but there are a lot of protocols and layer ones and whatnot that very much straddle the middle of the privacy line. And so how are you kind of thinking about that sector and being involved in that right now?
I'm happy to take a stab at this one. Or Brian, here, go. Wait, I see you.
I was just going to say, I think our government is very lazy, and this is a clear sign of how lazy they are. They kind of just did a blanket ban on it instead of actually going after the bad actors that are, you know, clearly using it. And it's not that hard, I think, to go after them. You have Chainalysis, which apparently has figured out how to you know, identify who is who with using Tornado Cash. I mean, at the end of the day, it's attack on free speech, I think, right? And, you know, code is speech at the end of the day. And Tornado Cash it wasn't for only, you know, moving money that you've stolen. It's for, you know, security and privacy too. Like, you know, people in this space need to be, you know, anonymous at times, so that, you know, people don't know how much money you have. I mean, people have been attacked in Brooklyn, where I live, for their crypto, because they're known influencers or something, and they've raided their homes, asked for their private keys or the ledgers, and they've lost their funds that way and they got attacked. So I think privacy chains and these privacy layers are super important in order for just the security of you as a person in this space. So it's super depressing, I think, what the government has done with Tornado Cash. I mean, I've never used it personally, I never had to, but I've had so many projects on our side where they use Tornado Cash just to test out their own protocol, create new wallets just so they're not, open to the public and easily accessible or viewable to the public, right? Because the blockchain is open source, anyone can read it. So there's many use cases for Tornado Cash. So it's very scary and depressing, but we'll keep investing in private chains on our side. We might invest in one layer 2 solution coming up, but it's not going to stop us. But it'd be interesting to see where everything goes forward. Curious on what you guys think.
Yeah, I'm happy to jump in, and I love that sentiment, Brian. The quick disclaimers: these are my opinions, so not necessarily representative of CoinFund or what we are or aren't doing with respect to like some of the dictums. But I do think, well, I do believe the right to privacy is extremely fundamental. I love that Web3 introduces so many new tools for maintaining that in an opt-in basis. Like you can be as private as you want or as open as you want, and people can choose how they want to face some of these autonomous protocols. And I think that's awesome. I think overall, my expectation is similar to the trend that Brian alerted to, or very informed by the trend that Brian alluded to, meaning the idea of encryption on the internet, used to be something that was required weapons export licenses, and people went to jail and there were court battles for it. But ultimately, I think the advent of the internet, and more specifically, the broad base of users coming online in the early, mid, and late 90s, and meant enforceability became untenable, but given the limited resources of the government to go after everyone that used RSA to send emails or whatever, kind of subsequent encryption standards also became adopted. I think that probably comes into play in Web3 as well, but it is going to be a bumpy road. I think ideally, I'd like to see agencies focus more on using some of the tools that are available, and as Brian noted, doing their job, building cases against actual bad actors. But maybe what can help them is the legislature having brighter line rules, not only delineating kind of the edge cases better, but also clarifying jurisdiction and which agencies should go after which types of people or lawbreakers, because I think there are some taxpayer resources right now being I don't know if the word's wasted, but certainly applied towards some of these turf wars, so to speak, that could probably be better resolved by the stroke of a pen from Congress. So there's a lot of work that I think our lawmakers in the US and globally can be doing. I know not just CoinFund, but others on this call also have folks that are working to kind of bridge that gap between regulators and be helpful, but also without sacrificing some of the, I think, really cool radical self-responsibility that Web3 is supportive of. I'm personally very supportive of. I think it gives us tools to take on more responsibility that we kind of gave up because there weren't better systems, but now that there are, I think it allows individuals to feel more empowered, whether it's privacy, whether it's security, et cetera. And I think that's great. So that was a bit of a tangent, but I just wanted to add on there.
Yeah, I think the guys really hit the nail on the head. Like, I would almost push back on the question, Jack, which was like, Tornado is further on the questionable side. Like, it really isn't no further than Cash. I think, alcohol producers and gun producers are probably more questionable than Tornado Cash. Like, Brian talked about crypto native folks needing to use Tornado, but if you're donating money for Ukraine, for example, and you're a Russian citizen living in the US, you don't think you're going to use Tornado for that transaction? Of course you are. Otherwise, when you go home, high chances that you're going to be questioned for a week and in some obscure setting you'd rather avoid. So I think it comes down to education and sort of a combined push from the industry on the policy side. Education probably that's bite-sized, because to Brian's point, the regulators have been, or the enforcement has been a little lazy on this one. And then continuing to back the space, right? Like part of true venture is backing stuff that matters 5 to 15 years out, as we've been saying throughout the call. And so I hope, and I think that all of us on this call and the types of firms we've been talking about will continue to do that, especially in the context of a portfolio approach where you can also make a couple investments that might be a little bit more centralized, sacrifice some of these things, but you kind of need to continue to back the stuff that moves the needle and introduces new primitives, right? We have privacy in the cash world. Why would we not have it digitally? So yeah, I'll kind of pause there.
No, yeah, I think that you're exactly right. I didn't want to insert my opinions too strongly into the fray, but I think that you guys really hit the nail on the head. We're coming up on just a few minutes left, so I'll toss us a quicker one to end it on. But what do you all, in a short response, think about the growth of RWAs or real world assets, specifically products that are trying to leverage higher off-chain yields right now? Because for the first time ever, we have higher off-chain than on-chain yields, and then pass those through to capital that's sourced on-chain. I know that's been a big boom right now. Do you think that's something that's long-term sustainable, or is it only kind of interesting in the mid to short term while we have this rate disparity?
So I'd love to take a first stab, and what I'll do is I'll drop a couple links right now in the chat if Heidi or you can pass that on to the other folks on the call, because I think the chat is just between us. But that's a theme we've been super active in throughout all our funds, our market neutral fund, our flagship directional hedge fund, our new credit strategy, as well as our venture strategy. And that's because we think in order for DeFi to grow and scale, you need to unlock uncollateralized credit. And in order for truly decentralized stablecoins, I guess DAI is on the spectrum, but DAI is definitely towards one end of the spectrum, to be able to scale themselves, you need more sustainable collateral, right? And so for all the crypto native reasons, this is a sector that needs to exist for DeFi to continue to grow and sort of, we hope, eat the traditional financial system the way software has. On the flip side, like private credit is probably very, very, very ripe for disruption, and the whole process needs to be thrown out the window. I'll also drop another link, which is our head of credit, writing on Packy's Not Boring newsletter that everything is broken. Hence, we're sort of making a push in protocols like Centrifuge and Maker. But, you know, I'm going to take a stance here and say long-term here to stay, not just a quick fad. And with that, to keep it short, I will pass it on to the other guys.
Yeah, I would say definitely here to stay. I was going to bring up Centrifuge too, as well, Thomas. So, I mean, real world assets on chain is definitely very interesting. And accounts receivable being one of them in terms of Centrifuge, I think is attractive in terms of just real yield. Because right now, you know, in DeFi, you got all this yield where you're like, where is it coming from, really? And it's just dripped from incentives to stake on the protocol. Whereas in this real yield, it's actual, you know, real world assets. And we're big believers in that in Republic. I know we got a little time, but I'll just highlight that you know, we're definitely seeing a push towards security tokens, and I don't know how long away it is, but we've actually built our own as well, which is called the Republic Note, putting our own assets on that. It's basically an index of all our investments, so we contribute a portion of our carry from every one of our divisions to the Republic Note. So if you're a holder of the note, you basically earn a portion of our carried interest as we exit some of these positions. So that's just one idea of how we're thinking about it on our side. But definitely there's a lot of exciting things going on in terms of just real world assets being on chain.
I don't have much to add beyond what the guy said. I do think, you know, zooming out a little philosophically, I don't know what the distinction between real versus unreal is. I think yield in general is just the idea of value that's thrown off by assets, and those assets can really live anywhere. So naturally, I think as Web3 technologies evolve, it'll pull in, whether kind of, if you think about it like in a bridge metaphor, I think it's bi-directional. So I just imagine in the future there will be yield, and if you really care to find out how mechanically it's sourced and allocated, then you could. But I suspect there will be Web3 DNA in whatever it is that is running behind the scenes.
Yeah,
agreed. I think that's the right answer
in the chat. Lily, I think some of the posts that the Thai team will pass along, notably that Not Boring post I referenced, will answer that question. But long story short, a lot of these protocols are somewhat have points of centralization because you do need to interact with the real world financial system. And then some of that is encoded in these contracts. So just wanted to address that question super quickly. Sorry, Jack.
No, you're all good. I'm happy you hit that. Thanks, Soleil, for asking. Always a good friend, and it comes with a good question. So the last thing I'd kind of note, Evan, to your point is, I was having a conversation with one of the big RWA protocols this morning, and one of the things that we were talking about is like the end game for any on-chain to off-chain lending protocol is basically like you are just offering a quote through someone sourcing capital, and your quote is just cheaper than everyone else's because your cost of capital is lower because you're able to source it on chain, right? And then that's kind of the end game, is they don't even know what the back end infrastructure looks like. But yeah, I know we're 2 minutes over, so without further ado, thank you everyone who tuned in today. Thank you to my fellow panelists for some really, really awesome discussion, and looking forward to catching everyone on the next webinar.
Thank you.
Thanks for having us. Cheers.
Yeah, thanks, Jack, Batai, Heidi. Really appreciate it. And thank you all for coming, for the attendees. Hopefully it was helpful.
Cheers.
Really
Take care.
enjoyed it.
Bye.